Let me now bring on board Harish Krishnan and let's take our conversation forward. He, of course, is co-CIO, Head of Equity with Aditya Birla Sun Life. Good morning.
Good morning, Nikunj. Happy to be on your show.
What's happening?
Well, a lot is happening if you were a macro watcher. And the newspaper headlines are
You'll talk
screaming.
Mahakumbh. Nobody talks about markets these days. I thought we'll talk about Mahakumbh, Afghanistan getting, England out of the tournament. Those are more exciting things, right? Markets to kar
Well,
lenge baat.
it's always good that you have other things going other than markets, because when there is an excessive focus on markets and that dominating all headlines, that is when sentiment possibly needs to be a lot more closely examined. But coming back to markets, Nikunj, at this point of time, they say that market looks at what the potential newspaper headlines can be, say, 6 to 12 months from now. They don't react on today's newspaper headlines. And therefore, when we look at how, we are, as market participants, constantly focused on two key areas. One is in terms of flows, key FIIs, how much are they going to sell and why are they selling? And second
बोल दिया
is in
फटाफट
terms
ऐसे
of the
दाओ.
uncertainty of Trump. I think with both of these, I would imagine that in under 6 to 12 months,
Right.
there can be a very big change than what is there today. So we're very positive on markets. This fall has kind of removed a lot of froth. Yes, at the small and micro caps, there still is some amount of froth, but I think overall, we
Right.
remain very positive from a 2 3 year perspective and beyond.
Harish, I'm sure you must have enjoyed this conversation. And I'm sure without even looking at your folio, you must be having exposure to both cement and wire and cable, right? Uh,
Yes.
what happens to these niche pockets? Like the paint industry got disrupted because of entry of Birla. Now the wire industry could get disrupted because of re-entry of Birla. The jewelry space is getting disrupted because Reliance entry. As a fund manager, and what I've seen in your portfolios is that you like to buy these niche businesses, but a lot of these niche businesses are now getting squashed.
Yes, so profit pools for a lot of these businesses are susceptible to disruption, be it new competition or new ways of doing businesses. The only difference, if I may, is that, for example, in the wires and cables business, we're talking about very small gross margins to start out with, unlike, say, the paints or many other businesses which have very high gross margins. So therefore, cost advantage definitely does play a very big role. Also, in terms of what Mr. Gupta was also rightly alluding to, it does take a significant amount of time to build the entire distribution network and roll it on credit, unlike a cash and carry business. So there are nuances for sure, but yes, we need to be prepared, and which is why we have a prudent diversification across various niches, like you rightly called out. Apart from buying the sectoral leaders in many of the other places or other sectors, which provide us both the agility to navigate each of these circumstances, as well as have a potential for growing the overall portfolio ahead of, say, the nominal GDP growth.
All right. Hi, Harish. This is Shrishti also joining in. Good to be speaking with you. That's one big headline, definitely, we are tracking. But the other big headline, Harish, today, of course, is the liquidity push by the RBI. They have been focusing on giving the push to some of these banking names, but now NBFC also joined the party. Give us a sense that what all is happening in this space, and which are the pockets that you find the most attractive bets at this point in time, and after this move, what actually changes?
So for about 18 months, we were negative on financials as the profit pool of the financial space had gone up significantly. Just the banking system had reached almost 1% of GDP, which was a 25-year high. And therefore, we kind of had a view that there would be either very high competition or regulatory intervention. About 3 months ago, we turned positive towards the overall banking space, especially towards private sector banks and NBFCs. And primarily, it was coming from the fact that we kind of felt that credit growth, which was at very high levels, had kind of tapered off. Net interest margins, which was extremely very high, that had also started coming off, and you had credit costs starting to go up. And more importantly, there was significant regulatory intervention. I think with the change in governor, clearly we've seen a significant U-turn in terms of regulatory interventions, both in terms of, say, tech embargoes, as well as the various kinds of liquidity provisions that the Reserve Bank is now currently bringing in. Therefore, it does appear that from a focus on macro stability, which the governor at the RBI was focused on, it appears that RBI is now training its guns on how to revive growth. Therefore, from a perspective, we think that private sector banks, which have derated significantly, are in a very good zone. Secondly, there has been a significant amount of cost increases that they have already taken over the course of the last 18-24 months. That is also in the base. And we don't think that, asset quality, while it is bad in certain pockets of microfinance and a lot of those unsecured lending, it is not endemic of the overall asset quality for the system as a whole. So I think a combination of each of these makes us positive on this overall space, including that of NBFCs, including that of private sector banks.
Harish, what matters is not what has happened. What matters is the 6 month out or a year out, where are we? Markets have corrected for two reasons. Earnings have slowed down and valuations were expensive. Let's examine both those factors. Where do valuations stand now and where are earnings headed? Once we know these 2 points, we can pretty much know the trajectory.
Absolutely. So you're bang on that earnings had started slowing from June quarter of last year. So we are now almost, say, 3 quarters into that, and possibly in Q1 of FY26, we will kind of complete the annualization of that slowdown. Point number two was that, while earnings in CY25 still may be sluggish, I think there have been two big policy resets that have happened in the month of February. First is as far as the budget is concerned. For almost 5 years, we had the budget focusing on supply side reforms, which is PLI, tax cuts, efficiency improvements on logistics, etc. I think there has been a big shift for the first time in 5 years that the government has now focused back on consumption with the tax cuts. It might be small, 1 lakh crores in the scheme of the bigger economy, but I think that signaling is far, far more powerful. Secondly, we will get into elections in two of the most popular states about 18 months from now, and the government will definitely start to bring in more SOPs and for the consumption-oriented sectors, say about under 6 to 12 months from now. The second bigger reset, like I said, is in terms of monetary policy. We had a very constructive monetary policy about a year from now, and we are now starting to loosen it quite significantly. The third, often not spoken about, is the currency depreciation. When currency does depreciate, of course, foreigners are wary about their local returns getting impacted by the currency depreciation, and there is a pullout. But what people don't realize is that Indian nominal earnings are significantly positively correlated with the depreciation of the rupee. In our analysis, almost 60% of the top line of the top 1,000 companies are dollarized. So therefore, whenever the rupee does stabilize, I'm not saying it should stabilize at 87, maybe it is 88 or 89. Once it stabilizes, we will see a tailwind of earnings growth coming from this pocket as well. Which is why when I said that, 6 to 12 months from now, we'll be talking of an earnings trajectory which will be markedly different from what we've seen in the last 4 or 5 quarters, and which is what makes us positive at the margin that a lot of froth has gone away. Now, coming to the second element that you rightly spoken about, how have valuations come off in this correction? So the median stock in BSE 500 has corrected by about 34%. This is data as of, say, last Thursday. Maybe it has gone up slightly more. Now, barring the global financial crisis and the COVID impact, which saw even higher drawdowns, 35-36% is broadly where most other corrections, and we do see a correction of this nature every once in 2 years or once in 3 years. So this is nothing unusual. So which again gives me a sense that a lot of the froth which had got built in is kind of behind us. Thirdly, coming to valuations, I think from the large cap sense, we definitely are in a zone wherein valuations are now at average levels. But if I go down to small and micro caps, there still is a pocket of overvaluation. When you think of the construct that we are in a slowing economic growth, at least for the next 12 months. Yes, there is going to be some acceleration beyond that. We think, therefore, that there is greater comfort in the larger companies at this point of time, is where we would be positioning ourselves.
I'll look at the other scenario, Harish, and you never say never, which is that world slows down, tariffs are at play, US fiscal deficit concerns, they start haunting us. What is looking like an opportunity for India becomes a global threat. What are the chances that globally something goes wrong, which it could, and then we fall further?
Sure. So I think Trump and his associated uncertainty is something that we have to live with for under 4 years. There's no doubt about that. And therefore, every morning we have to look at what X brings in the form of his tweets. But I think that, Mr. Trump and his administration is currently at its strongest because they have an absolute majority and they have a thumping mandate from the electorate. But go 6 months, 9 months into the administration with the party wanting to retain its seats in the House and the Senate, I think that there will be a moderation in some of these policies. So that's point number one. Second point is that it is not that Trump uncertainty only impacts India. In fact, if one may argue that we are possibly one of the lesser impacted countries given our standing and equation on the geopolitical front. If I look at global markets, it appears that most of the rest of the world, including some of the markets which are otherwise perceived to be significantly impacted by his policies, be it Mexico, be it countries in the Europe or in China, their equity markets are singing a very different tune. So I think that, while of course this is a probability and there is a hypothetical scenario that the global growth slows down and one should be watchful about that, no doubt about it. But I think that, about 6 months back, it did appear that the global growth cycle is going to be a lot stronger with the US, Mr. Trump announcing that there'll be further tax cuts, China saying that they are going to have higher fiscal deficits, and India was oddity in that sense that we were running counter-cyclical both fiscally as well as monetarily. I think we have also now moved, like I explained in the previous answer, that we've also moved fiscally and monetarily. So I think that, in totality, given the opportunity that it currently presents, I would still be saying that, one needs to take up equity exposure at this point of time. Of course, this is not a slam dunk market where valuations have come to an extreme bargain, where we can be saying that all of these risks are priced in. But to constantly be worried about what Mr. Trump will do or what the flows are going to suggest, I think people may miss the opportunity that it presents itself today.
Makes sense. Harish, great to have you on the show. Thank you so much for your time today.
If you like this video, then like, share and subscribe to ET Now.